Mortgage rates just hit their year-to-date high, 6.65%. This is a brutal number, and it comes after we just saw the 10-year yield go well above 4.5. Is the 10-year going to go up to 5%? Are mortgage rates going to go back up to 7? The last time we saw a 4.59% on the 10-year yield was May 21st of last year. Well, if we look at mortgage rates on May 21st of last year, they were over 7%. Mortgage rates are a half a point lower than where they were last year, even though inflation is accelerating higher. There's a lot of uncertainty out there. So what I want to do today is just peel back the curtain. What is happening currently in the market? What are we seeing as leading indicators? What can we learn from those leading indicators? And how can that set us up for understanding what's going to happen over the next few months? If you look at contract volume, it's up 12.9%. Nashville demand is up 12.9%. However, 2/3 of the contract increase is coming from the 750 price point and above. Okay. Now think about this. If the median price is $500,000 and 2/3 of the demand increase, year-over-year demand increase, is coming from price points that are 50% higher than the median price, what do you think happens to the median price? It is going to go up. We are going to very likely hit a record on median sales price in May, and it will be driven by this K-shape massive melt up. But the 10-year is starting to skyrocket. Whenever the 10-year yield went over 4.5%, it really started putting downward pressure on stocks, and stocks really sold off. What does that have to do with the housing market? $2 million listings are now at 148 contracts as of this past week. 148 contracts. We've never had that many under contract in the $2 million space, okay? But when we overlay the NASDAQ composite, what we see is that the NASDAQ is melting up with the $2 million transaction. Now keep in mind, this is not price. Price is very flat. I'm going to show you that in just a minute. Last year at this time, mortgage rates were trending down. This year, they seem to be trending up. At the end of June last year, we were moving under 7. We could see demand flip. Guess what happens to the $2 million market when the stock market starts going down? It's a pretty high correlation. We could see some downward pressure on a market that's been really booming this year. The reason that's important is because when we get to price, even though we're about to get a median sales price record, if we look at contract price per foot, it is very flat. That means that home values aren't really changing. You can pick your price band. Even in the $2 million space, median contract price per foot is actually negative year over year. It's been very flat. It's been running in this range for years. Now, there's not a ton of them, so it does distort a little bit. But even if you do the 1 to 2 million, 750 to a million, it doesn't matter what price point you're in. The median sales price per foot is flat to negative, while the median sales price is on its way to hit a new all-time high in Nashville. You're going to hear headlines, median sales price all-time high, but it just doesn't reflect what people are experiencing in the market as buyers or as sellers. Buyers are able to negotiate way more right now. Why is that? Well, if we look at price cuts as a percentage of active listings, what we see, even though it's a little bit lower than where it was last year, it kind of tailed off last week, and we started seeing these bonds sell off. Stock market started dropping a little bit. Price cuts are still increasing as a percentage of active listings, but now they're below where they were last year. This is really important because we still hit that 35% mark in May. We did not do that in 2024 until the mid-June. This is setting the stage for what I feel like could be a very squishy fall. Very squishy. Okay. Now it can all change. It can all change on the flip of a dime. Just like it changed now, we could see all kinds of macro events that could completely flip this. But right now, things are starting to shape up with mortgage rates skyrocketing, with price cuts starting to move up above that 35%, even though they're lower than where they were last year, which is a bullish signal for right now. it's still suggesting the next 90 days could get very soft. I would say that the risk is to the downside right now on prices. When I forecasted Nashville, I said the median price would come in at -1% to +3%. I would probably drop that just a little bit. Maybe I'd move that down just 1% or 2%. The crazy thing is, it really just depends on which area you're looking, what is actually happening. If we look at the under contract listings for the $2 million, almost all of it is in Davidson and Williamson. If you look at the under 300, what you see is that contract volume is still sputtering. It just doesn't matter. If you look at the 300 to 500, it's still sputtering. These are the underside of the median. It's struggling. It makes this masking of what is happening in the housing market extraordinarily important, which is why I think you should always be looking at neighborhood by neighborhood and not aggregate data, because that's going to tell you really what's going on. If we look at the active contract ratio, if we take the active listings compared to the contract volume and then look at shifts compared to last year, that's what this chart is. You can see the red is hotter than it was last year. The blue is colder than where it was last year. You can see it's speckled all over the place. In fact, I completely roasted a neighborhood just a few weeks ago for having almost no contract volume, massive dark shift. Now look at it. It's got 11 under contract. Last year it had 7. It's got 17 active listings. Last year it had 20. This market, this Canterbury neighborhood actually flipped after I called it out as being a major negative. I actually have one in contract in this neighborhood. I'm super excited about it. It's assumable. It's a 3.75% mortgage. I actually had to convince the seller by promising I would pay their mortgage. I'm literally going to pay his mortgage if this thing doesn't close on time. I'm going to pay principal, interest, taxes, insurance. I'm going to pay it all if this thing doesn't close on time. I guaranteed we could get it closed on time, and I actually think we're going to get it closed. It's coming down the pipe, and my buyer's going to get a 3.75% mortgage, but I really put my neck on the line for this one. We'll see. Anything can derail it. It's not closed yet. The point is that while we can speculate where prices are going and what macroeconomic conditions will lead to, we can use data to our advantage in the market as it is right now to get a better than average value. This is one of the most effective and powerful things you can do, is to recognize opportunity and take advantage of it by using neighborhood level data that tells you how the temperature has changed, that identifies whether or not sellers are more motivated now than they were last week or the month before or the year before. So, will mortgage rates derail the market? Look for them to be year-over-year higher before they really start suppressing demand. Right now, it is not year-over-year higher. It's 6.65. Last year, it was 6.9. But if we go another month, by the end of June, it was 6.67. And if this goes up to 6.9, so in other words, if we're shifting higher year over year, I would expect the latter half of this year to be softer, lower demand than it was last year. Complete reverse, especially as the 10-year goes above 4.5, puts downward pressure on stocks. That's definitely going to take some wind out of the sails of the $2 million market. I am bullish on Nashville long-term. There's a lot of great demographic situations there for housing long-term, but depending on the price band, depending on the location, and depending on what happens with the macroeconomics, we could have a very soft fall. Thank you so much for watching. I look forward to seeing you next Saturday. Have a great weekend.